Welcome back. Today, we're diving deep into the tech titan Alphabet, the parent company of Google. We all know the company dominates, but what do its fundamentals and technical picture truly show? I'll show you why this stock is not just robust, but also dangerously risky, and how a perfect storm could trigger a massive, once-in-a-decade correction of over 40%. Stay tuned, because I'll reveal precisely when it might be time to buy. Recently, Alphabet secured a major victory in a key antitrust case against the U.S. government. The ruling was a massive relief for the market, easing years of investor anxiety. However, buried within the court's reasoning was a crucial, often overlooked warning. The biggest existential threat to Google isn't regulation, but the rapidly emerging new AI competition. This brings us directly to our fundamental analysis. Alphabet is a financial powerhouse, but to fully grasp its potential, we must look beyond the surface. Let's start with the incredible top-line growth. Over the last 5 years, Google's revenue has exploded from around $162 billion in 2019 to over $350 billion in 2024. Net income climbed from $34 billion to over $100 billion in the same period, weathering a slight dip in 2022. Analysts are confident this growth will continue, projecting revenues to exceed $470 billion by 2027. The stock currently trades at a price-to-earnings ratio of around 25, which, while slightly above its 5-year average of about 23, remains within a historically fair valuation range. This leaves room for a re-rating higher, but also makes it vulnerable to a downturn. The company's core ad business is maturing, but here's the crucial point. The new essential growth narrative for investors is Google Cloud. Its rapid descent is not just about new revenue. It's about positioning Alphabet as a truly diversified technology company, a fierce competitor to Amazon's AWS and Microsoft's Azure. Its growth is proof that Google can successfully innovate and monetize outside of its traditional search empire, a narrative the market desperately needs to believe. Despite these strong fundamentals, there are 3 powerful risks that, if they converge, could create the perfect storm and trigger a correction of over 40%. The first is systemic market risk. Google is not immune to a broader market downturn. In a widespread recession, companies are the first to slash their advertising budgets, which would directly impact Alphabet's primary revenue stream. Historically, ad spending is one of the first things to get cut in a corporate budget crunch, making Google's main engine extremely susceptible to economic headwinds. The second major risk is the AI investment dilemma. While the market loves the idea of AI, it's ignoring the staggering cost. The race for AI supremacy is a capital expenditure arms race. Google must pour tens of billions of dollars annually into building new data centers and buying incredibly expensive specialized chips, think NVIDIA's high-end GPUs, just to keep pace with competitors. These investments are an immense drag on profit margins and a massive bet on a long-term future without any guarantee of a profitable return in the short to medium term. This puts Google in a dangerous position where it is forced to spend just to compete, with no certainty of a payoff. Finally, the third risk is the infamous Other Bets division. Projects like Waymo, which is working on self-driving cars, and Verily, a life sciences company, have consistently burned billions in losses for years. As long as the core business is booming, the market tolerates these losses as R&D. In a downturn, however, when advertising revenue shrinks and profits fall, these consistent cash-burning businesses will become a massive financial burden, a liability that investors will suddenly care a great deal about. Now for the second part of our analysis, the technical picture. Here we set the fundamentals aside and focus on what the charts tell us about market psychology. My analysis shows that after a prolonged gradual climb, the Google stock has recently been in a highly concentrated bullish to bearish transition phase. For months, a strong but final bullish rally fooled many investors into believing the coast was clear. But that momentum has now faded. This is the decisive moment. The stock has now hit my critical resistance zone between $223 and $249.
This is where the price action shows clear signs of exhausting its upward power. We see a significant bearish divergence in key oscillators, signaling that the underlying buying pressure is weakening even as the price has pushed higher. This zone is a historical ceiling where sellers have repeatedly entered the market, and the stock has walked right into their trap. Now that it has caught in this sell zone, I anticipate the price will begin to fall very quickly. My technical projection for this decline is that it will be at least 40% from these highs, potentially finding support around the mid-140s, a level last seen a year ago. However, we must also consider a bullish alternative. If, for some reason, the stock manages to break and hold definitively above this critical resistance zone of $249, it could trigger a final impulsive rally to the next major psychological level, possibly reaching as high as 270. This move would be driven by short-term momentum and would likely pull in a new wave of retail investors. While this scenario is a possibility and could represent a brief opportunity for traders, it does not change my overall midterm outlook. Even if we see this short-term rally, the fundamental risks, the high AI capital expenditures, the other bets losses, and the potential for a broader economic recession remain. My conviction for a significant correction in 2026 remains strong, as these macro-level issues are far more powerful than any short-term momentum. When all these factors converge, the technical signals, the market risks, the capital-intensive AI spending, and the other bets liabilities, the Google stock will be driven down to a price level that we might only see once in a decade. And this is where my extreme bullishness on Google begins. The company's core technological dominance, its incredible talent pool, and the long-term potential of its diverse business units will not disappear. When the stock corrects by at least 40% from its high, a massive margin of safety will open up, creating an unprecedented opportunity for long-term investors. That's when Alphabet will become a true bargain.